This video is about JEPI, which is the most requested covered call ETF in the comments that you guys made to my video on QYLD a couple weeks ago. Be sure to stick around until the end of this video because I will be comparing JEPI to QYLD, plus a couple other alternatives for yield-hungry investors. Hi, I'm Dave Van Nat. Before I get going, please help us out by clicking the thumb up button if you like this content, subscribing to our channel, and ringing the bell for notifications about new videos when we put them up. Thank you. As you probably know, covered call ETFs are growing in popularity among dividend investors. A few of them are among the fastest growing ETFs in existence. Their obvious attraction is high yields, which range from 6% all the way up to 12%. A couple weeks ago, I did a deep dive into QYLD, which is the NASDAQ 100 covered call ETF. If you'd like to catch up on that ETF, please see my video dated October 7th, or just stick around with this one because QYLD will be included in my comparison at the end of the video. But first, let's take a look at JEPI, which is the JPMorgan Equity Income Premium ETF. As I said, the attraction of these ETFs is their ability to generate high yields. So let's start by refreshing our memory on how they do that. This display shows you how call options generate income. In the first column, the first thing that happens is the ETF sells the option. That means that the ETF writes the option to a buyer. The ETF receives a premium for writing that call and selling it to the buyer, and the ETF will keep that premium no matter what happens afterwards. Column 2, the option conveys the right to buy the security that the option covers at something called the strike price. Column 3, the option buyer pays the premium for the option in return for receiving that right. The buyer does not have to exercise that right. Column 4, the term of any option varies, but with ETFs, what I've seen is that most of them are for 1 month. Column 5, the option is exercised if the strike price is hit. That means that if the strike price is hit, the buyer of the option who bought a right to call the stock away from the seller of the option, which is the ETF, if the strike price is hit, meaning that the price of the stock or the security goes above the strike price, that means the buyer can get it cheaper by exercising the option than they can buying it on the open market. If the buyer chooses to exercise the option, the seller must convey the securities to the buyer at that strike price. And finally, in column 6, the option won't be exercised if the strike price is not hit, because obviously it's not advantageous to the buyer of the option to exercise it. In that case, the seller, the ETF, keeps the securities. And that's how they work. Any individual investor can write options on their own. The ETFs that we're talking about do it for you, charging a fee for the service. JEPI has only existed since 2020, but its popularity has skyrocketed since being introduced. It surpassed $1 billion in assets under management in its first year, and it has since passed the $4 billion mark. Let's see what all the excitement is about. This table summarizes JEPI. It was launched in May 2020. Its size now has reached $4.1 billion, which makes it just a little slightly smaller than QYLD. It has no underlying index. JEPI is unique among ETFs that I've looked at in that it's not based on an index. It is an active fund run directly by its managers who create its own proprietary portfolio and actively execute their strategy. Its yield currently is about 7.5%. It pays monthly. It has an expense ratio that I would call moderate as these things go at 0.35%, and it holds about 100 stocks. It's important to remember that covered call strategies inherently forfeit stock price upside in exchange for current income. That's because call options give the buyers the right to take ownership of the stock, i.e. to call it away, if the strike price is exceeded. So the option seller, JEPI in this case, does not participate in price upside beyond the strike price, but it is still exposed to price downside, slightly offset by the premiums collected. That inherent forfeiture of price upside is illustrated by this graphic from Morningstar. The numbers here only pertain to the category of ETFs that we're talking about. I couldn't find a specific one on JEPI, but they give you an idea of how it works. Morningstar uses what they call capture ratios, and on the first line you can see that when an upside capture ratio means how much does the ETF grab when the price is going up. And that gets a red 66, which means that the ETF grabs only 66% of the price upside compared to the index, which in this case is the S&P 500. The second line, the downside capture ratio, shows how much of the downside the ETF grabs or suffers when the price of the stocks are going down, and that gets a green 83, meaning that the ETF suffers only 83% of the downside. Morningstar colors it green, meaning that it's outperforming the index on the downside, but the red 66 meant it was underperforming the index on the upside. Thus, the ideal scenario for a call writer, which is JEPI in our case, is low volatility. If the strike price is not hit during the term of the option, the call writer keeps all the shares and the premiums too. JEPI's portfolio consists of the stocks that it owns plus exchange-linked notes, or ELNs, that are used to execute the covered call strategy. Let's look at the stocks first. This display shows the top 20 stocks currently in JEPI's portfolio. The reason I'm showing 20 stocks rather than 10 is because they're more equally weighted than I'm accustomed to seeing in a portfolio. So I'm showing you 20 of them rather than 10 to show more of the substance of the portfolio. Overall, there are 100 stocks in JEPI's portfolio. And it looks like kind of an ordinary list of stocks, some recognizable names, some less recognizable. Notice in the last column, the economic moat exists at either a wide or narrow rating from Morningstar, suggesting that the stocks that JEPI has chosen, again, it's not based on an index, they are actively selecting stocks for their portfolio. And all those moat ratings suggest that this is a pretty high quality selection of stocks. As shown on this graphic, Morningstar considers JEPI to be a large cap blend portfolio. Blend in this case means that it's a mixture of value and growth styles for this ETF. Here is JEPI's portfolio as depicted by JPMorgan itself. Notice that 6 of the top 10 holdings are equity-linked notes. They are the ones labeled SPX in the list. They are the largest holdings in the ETF. The first stock is holding number 7 in terms of size. You don't need to understand the complexities of exchange-linked notes. Just know that they are used for JEPI to execute its covered call strategy. JEPI states 4 performance objectives in its literature and marketing. First, JEPI states that it strives to provide current income. They do not go out on a limb here. They don't say high current income. On this slide, we can see JEPI's income beginning in July 21. I should say we can see its yield beginning in July 2021, which is just a few months ago. You may recall that JEPI started a little over a year ago, but with ETFs, because the monthly payouts vary, the yield is always calculated on a backwards 12-month looking basis rather than a forward 12-month looking basis because you can't project the most recent payout forward. So this slide only covers the last few months, and you can see that JEPI's yield was at a peak a little over 7.8% at the beginning of this time period in July, and lately it seems to have settled in at a yield of around 7.5%. And I'm going to use that as kind of the accepted or common yield of JEPI throughout this video. 7.5% yield is quite good, but let's remember that we're dealing with a very small sample here. So the reliability of that number is a bit up in the air because of JEPI's short life. JEPI's second goal is to make monthly distributions. And as you can see from this chart, it has done so. This chart now goes all the way back to July of 20 when the ETF was first introduced. They've made distributions each month since then. As with all ETFs, the payments vary from month to month. And as I look at this display, if I were going to describe a trend line, it seems like it's slightly down overall, but it's stabilized over the last few months. JEPI's third stated objective is maintaining prospects for capital appreciation. This display shows JEPI's price-only returns, 21% in orange, and its total returns with dividends reinvested, 35% shown in purple. As you would expect, reinvesting the high dividends makes a big difference for JEPI. It increases its total returns by 2/3. For the same time period, for comparison, the S&P 500 ETF had total returns with dividends reinvested of 47%. So that means that JEPI has produced 74% of SPY's S&P 500's total returns with dividend reinvested since JEPI was introduced last year. Okay. JEPI's fourth and final stated objective is reduced volatility, and we can see that it has achieved that on this chart. JEPI is in purple, and its volatility, which again can only be measured starting 1 year after it was introduced, has hung around in the 60 to 70% range of the S&P 500. S&P 500 is shown by the orange line, and this shows beta, which is a measure of volatility, and by definition, a beta of 1.00 is assigned to the S&P 500. So SPY's beta, which tracks the S&P 500, hangs around the 1.0 mark, 0.99 for the length of the slide, and that's what you would expect. JEPI's volatility is quite a bit lower than that. So that fourth objective has been achieved. So in summary, I would say that JEPI has been hitting its targets since its introduction. Its 7.5% yield is very good. It pays monthly. Its total return has achieved 74% of the S&P 500, both with dividends reinvested. And finally, its volatility has been quite a bit less than the S&P 500. Even though JEPI is purchased by most investors for its income investors need to understand the trade-offs that they make to get that income. For that reason, I feel that it is proper to examine JEPI's total returns in comparison to some alternative investments. And I have 3 comparisons to show you. The first comparison is with the plain vanilla S&P 500. And in all of these charts, JEPI is the purple line and the comparison ETF or investment is the orange line. This chart shows the prices of the 2 ETFs, JEPI and SPY, which tracks the S&P 500. And we can see that the price of the S&P 500 in the time that JEPI has existed has far exceeded JEPI's price rise. In that time frame, which is short again, S&P 500 has gone up 51% compared to JEPI's 22%. And this slide shows total returns with dividends reinvested. This is a better indicator for accumulators, I think, because JEPI's high dividends produce much more compounding than SPY's puny 1.3% yield. In this short time frame since JEPI has existed, it has produced 35% total returns compared to SPY's 47% with dividends reinvested for both. My second comparison is a covered call ETF for the S&P 500. Global X, which is the company that produces QYLD, also offers a covered call ETF where the stock index is the S&P 500. This ETF, which is called the Global X S&P 500 Covered Call ETF, to no surprise, is attracting a lot of money from investors as well as the others that we've talked about. It has a current yield of about 6.3%. And you can see that JEPI has bested the Global X ETF by about 3% over the short time that JEPI has existed. Once again, the short time frame makes it hard to tell whether that is a significant outperformance or not, or whether it is sustainable or not. My last comparison is a closed-end fund. This is the Nuveen S&P 500 Buy Right Income Fund, which has a ticker symbol of BXMX. It's been around since 2004. It yields about 6% distributed quarterly, not monthly. As you can see, Nuveen's CEF, based on a similar strategy to JEPI's approach, has outperformed JEPI by 12 percentage points in the short time that JEPI has been around. JEPI has returned 72% of BXMX's total returns with dividends reinvested. Now let's compare across the funds I've covered in the 2 videos I've done on covered call ETFs. This table covers all the important stuff. The funds are ordered from top to bottom by how long they've been around. The 2 green lines on the table are old-fashioned index funds. The 2 orange lines are closed-end funds that use the covered call strategy. And the 3 blue lines are the covered call ETFs that I've analyzed in detail, which are QYLD and JEPI, plus XYLD, which I've included to illustrate the covered call strategy applied to the S&P 500. The green and red highlights show the best and worst fund on each of the factors shown in the columns. Taking everything into account, here's what I think. As an income investor, if it were me, I would probably select QYLD from that list. It has a single best designation for its high yield, currently 10.5%. It has no worst designations. It supplies the most income that, as a dividend growth investor, I could compound into other dividend growth stocks. Most of its income is return of capital, which reduces your cost basis, but goes untaxed until you sell your shares, and that's considered to be a benefit by many investors. And finally, its share price stays flat in a tight range, usually between $20 and $25. It stays in that range most of the time, so most of its return comes from the dividend itself, which is proven to be reliable. JEPI's short history would probably disqualify it for me at this time. I have always required at least 5 years of operating history to select any investment, and I see no reason to depart from that practice for JEPI. That said, if JEPI's performance holds up, I think it has a really attractive combination of yield at 7.5% and total returns, as we saw in prior charts. Just one final thought. Making good investment choices always depends on your goals. Covered call funds trade or convert total returns over time for more current income. That is baked into their design. Just remember that when you are thinking about them. They will inevitably underperform the stock portfolios on which they are based. And that's a wrap on this video. Thanks for watching, everybody. Bye-bye.